Good morning, everybody. Welcome to the Reserve Bank. Welcome to our March monetary policy statement. I'm Alan Bollard. The Reserve Bank this morning is leaving the official cash rate unchanged at 2.5%. Inflation has settled near the middle of the Reserve Bank's target range, and inflation expectations have fallen. On the domestic economy, we're seeing some signs of recovery. Household spending appears to have picked up over the past few months, and recovery in the building sector is also now underway. That recovery will strengthen as repairs and reconstruction in Canterbury pick up later in the year. In addition, high export commodity prices are also helping support a continued recovery in domestic activity. Policy actions from a number of central banks around the world have boosted global confidence recently. While this is encouraging, financial market sentiment does remain fragile and risks to the global outlook still remain. And furthermore, the easing in global monetary policy that we've seen and the resultant increase in risk appetites in financial markets has contributed to some of the appreciation that we've seen in the New Zealand dollar. While helping to contain inflation in New Zealand, that high value of the New Zealand dollar is, we believe, detrimental to the tradable sector here, and is undermining some aspects of New Zealand's GDP growth recovery and inhibiting rebalancing in the New Zealand economy. Sustained strength in the New Zealand dollar would reduce the need we feel for future increases in the official cash rate. Given the medium-term outlook for inflation, it remains prudent for us to hold the official cash rate at 2.5%. Thank you. That's the end of the formal statement. We're here to answer any questions. To assist, I've got Dr. McDermott, Head of Economics, and Dean Ford, Head of Forecasting. Any questions, ladies and gentlemen?
So, Dr. Bollard, how long do you believe that 2.5% is going to remain?
Well, you'll see in our forecasts that it's not inconsistent with a story which would see that remaining in place for much of this year. Now, that, of course, depends on events. If those change, we'll change. But the picture at the minute is that in many respects, inflation's in a reasonably sweet spot, and that doesn't require a lot of monetary policy change.
Two questions. One is you talk about the risk of a disorderly default in Europe having declined. Does that mean you still see the risk of an orderly default as being quite possible?
The European situation is just going to continue to be very fragile, and there's going to be shocks and surprises and ups and downs there. What we have seen is a significant improvement in financial market confidence when it comes to the availability of liquidity for European banks. The ECB's actions late last year and the two tenders since then have led to a lot of liquidity going through the system. I don't think anybody thinks that that solves the capital problems that exist in some European banks. It has helped fund some of the southern European sovereign governments. But again, I don't think anyone sees that as solving the structural problems that are still there in those economies. So we see a holding action that has improved confidence, that has improved liquidity, but hasn't in itself solved structural things that are still there ahead of us.
Am I interpreting it right when in concluding that your outlook for New Zealand bank funding costs going up this year isn't as you're not as concerned about that as you were back in December?
We felt around the time of our December monetary policy statement that there were some concerns about the fact that secured funding markets in Europe had, for the time, got very, very tight and showed some aspects of freezing. That's come off quite a lot now. We're encouraged by the fact that Australian and more New Zealand banks are being able to re-access the secured medium-term funding markets there. That's important. In addition, as you know, New Zealand bank balance sheets look in very good shape, partly because New Zealanders are saving a lot more domestically and partly because the rates of credit growth are very, very limited. So that has eased those funding concerns.
Sorry, one supplementary. Has your outlook for what might be the neutral level of OCR, has that come back a little bit from where you might have been last year?
Oh, John, would you like to do your best to answer that question?
Well, the short answer is no, not really. The big thing that has shifted where neutral is the premium that banks have to pay to secure funding. That's been around for quite some time now. And of course, the thing that moves slowly is how sensitive New Zealand households are to interest rates. And we think they're probably a bit more sensitive than where they were a few years ago.
Thank you.
Is there any concern that by leaving the official cash rate at 2.5% this year that you may see a bit of a housing boom with lower interest rates?
Oh, we think we're seeing some recovery in the housing market, which is broadly in line with what I think you might hope for from a national point of view. So we've seen some increase in sales, we've seen some increases in consents. We are expecting to see a growth in residential investment this year. We're not expecting to see much pressure on prices. In addition, of course, the Christchurch rebuild is likely to start becoming much more obvious in months later this year and then really cutting in next year. So we're expecting to see some reasonable sort of activity there. And to the extent to which that's driven by demographics and the fact that there has been very little investment for some years, that's a desirable thing, not a worrying thing.
Dr. Boland, how concerned are you by the level of the dollar, and is monetary policy the only thing you have in mind in terms of combating it if it remains at these sorts of levels?
Well, the New Zealand dollar, especially where it was last week, was of concern to us. As you're aware, it and a number of other small open economies having their currency driven quite high by a number of features, principally from offshore. We do observe in the statement that we've seen an unusual combination of monetary stimulus being delivered by really certainly G3 economy banks around the world. We're now seeing the Federal Reserve, which has extended its outlook for the time when it expects rates to be extraordinarily low. We've seen the European Central Bank put in place its LTRO system of funding, which is a different form of quantitative easing. We've seen the Bank of England increasing its quantitative easing. We're hearing some more things from the Bank of Japan, and arguably a little different, but over the last week we've seen from the People's Bank of China some further easing in monetary conditions as well. When that all happens, we do worry about the potential for competitive monetary stimulus, and it certainly would be a disappointment if we'd got this far through the global financial crisis without an outbreak of competitive trade barriers, as we had worried about, only to run into competitive monetary stimulus. I think we all know that there's a number of countries around the world who are quite concerned about this at the minute. They're ones with their own currencies. It's not just New Zealand. Put in the same boat Australia, Canada, some of the Scandinavians, some of the Latin Americans, and some of the Eastern Europeans as well. But at least from our point of view, we do see that being driven, at least in its recent manifestations, primarily from international pressures rather than from New Zealand pressures. And in that sense, it's limited what New Zealand can hope to do about it. Of course, were we to see strengthening New Zealand dollar, and were we to see that strengthen to a point where it was actually bringing down our future expectations of inflation, then we always still have the prospect of reducing the official cash rate in response to that.
Dr. Bollard, I was just kind of curious, the separate inflation sort of expectations, how much of an impact is the Kiwi dollar having on that? I mean, is it sort of in the domestic economy as well, or is it is that tradable inflation the main thing damping it?
I think it does have its impact, but it's not just tradable. We've also seen indications about expectations around non-tradables and forecasts on non-tradables quite repressed as well. So I think it's fairly broad across the economy.
In previous statements, you've talked about interventions by other central banks and that you'd watch with interest how effective those were. Do you have more of a established view now on how effective they have been, and does that have any implications for whether or not New Zealand might go down that track if the New Zealand dollar stayed up?
Well, as you know, we won't comment on possibilities of intervention. The Swiss experience has been quite interesting, although it's had some peripheral problems around, and of course last year the Swiss National Bank made massive losses. The Japanese interventions look to have been less successful. We continue to survey some of the attempts at capital controls in some other countries, but there hasn't actually been a lot more new happening recently.
What are you seeing in terms of bank funding costs and their possible impacts on floating mortgage rates if the OCR weren't to move? We've seen in Australia that a few banks over there are assessing sort of every month their floating rates, regardless of what the official rate is at. So what are you guys seeing around there?
Well, look, I'd first make a point that in New Zealand we accept that the official cash rate is only one of the features that impacts on cost of funds, and we've never expected to see a mechanical type relationship between that and funding more generally. But I wonder if I might ask Jason Wong, Head of our Financial Markets Intelligence, to answer that. If you could grab a microphone, thanks.
Yeah, obviously we monitor bank funding costs pretty closely, and particularly the long-term wholesale funding markets. And of course we've seen some easing in conditions there in Europe. But what's actually happened is the cost, despite the slightly lower cost of issuing debt in Europe, when you start to hedge it back into New Zealand dollars, that cost has actually increased. So some of the recent deals we've seen by banks have actually been more expensive, slightly more expensive than we saw at the end of last year, despite some freeing up in the markets. But I guess an also interesting development is that we have seen that upward pressure on bank funding costs continue, and yet we've seen reductions in fixed rate mortgages since our last statement. So while costs are going up, obviously the banks have some comfort in that at this stage to be able to reduce their mortgage rates. So it's another indication that costs are there, but it's not really impacting too much on behaviour.
If funding costs do stay at this level, could there be an effect over the next year?
I guess the key determinant is credit growth and deposit growth, and at the moment deposit growth is running well in excess of credit growth, so the banks don't actually need to rush out and fund at these higher rates. They're getting lots of money in the door, and it's taking the pressure off them funding. So, I mean, it's a pretty hard variable to forecast, but that momentum is still there, definitely deposit growth remaining pretty strong. So the banks can take all those deposits and fund any new credit growth and actually pay off debt that comes up for maturing.
Dr. Bollard, just looking at the Rugby World Cup and the effect that $925 million has had on the economy, how would you characterise that boost? And what was crowded out? And what do you think we've lost by what you've described as crowding out during that time?
Yeah, well, it's still less than totally clear, and it's something we've got to bear in mind when, for the fourth quarter numbers, generally they're quite noisy because of that. There was a big increase in spend as a result of that. There was big crowd outs as well. We've noticed that quite a lot in our business visits, where there's some areas that just slowed down and contracted very significantly through that time. I don't know if there's a lot more we can say, Dean.
Well, I can probably give some detail there. So, for instance, it was difficult to try and get a hotel in Auckland for things other than Rugby World Cup at the time. So there was obviously some business activity that just couldn't occur. But also a big part of the spend on the Rugby World Cup wasn't tourists. It was New Zealanders going to the games as well. And people have a fixed budget for spending on entertainment. If you go to a rugby game, you can't go to other different entertainment things. So it would have been other restaurants and movies and what have you that wouldn't have done as well through that time.
So, Dr. Bollard, how do you know, was it a big boost or how noticeable was it, do you think?
Well, I noticed it. It was a significant boost.
Dr. Bollard, the bank's forecast still has the government in deficit by 14-15, which is not the government's view. Can you elaborate on the difference between these?
Yeah, we do have a slight difference on the fiscal side where we've got a small but negative number on operating balance that year. I don't think there's a lot in that, but it does reflect a slightly different view on our GDP track and also with lower inflation. So there is a bit of a difference in there. It's at the margins rather than anything significant.
So so you think the government is... Oh, sorry. So you think the government has been a little optimistic with their plan there?
No, I mean, clearly the government's going to have to keep monitoring and working out their own fiscal numbers, and it basically says it's very difficult for a government in this situation to relax around that. But as I say, the absolute number difference isn't particularly great.
Dr. Bollard, in terms of the high exchange rate, what sectors of the export markets do you think are most exposed, and what kind of damage would the high currency do over the next year?
Well, the currency's off a little bit from what it was last week, and of course that's a difficulty in talking about all of this. It's volatility as well. We've certainly noticed it in tourism, or some aspects of tourism, that has quite a big impact. But more generally, when we look across the manufacturing sector, we don't find so much across the board damage from the exchange rate to exports. We see it on import competition, and that does look like the sector that has been hit most over the last couple of years by these higher levels of the exchange rate, part of which, of course, are justified by strong commodity prices, but part of which we think go beyond that.
Sorry, just to follow up then, part of it not justified, do you have a sense of how overvalued the currency is then?
We've got a number of different models that we run on that, and they show some quite different things, but they do show, in our view, that it's higher than it would be than you would expect it to be on any of the normal determinants that we would run in those models.
So you're talking 10, 15%?
No, I'm not going to put a number on. We do get quite big range in some of those things.
Just if major central banks do continue their easing and expanding their balance sheet, should we expect the New Zealand dollar to keep rising? What's the risk of that happening? You've put in a slight depreciation, but what's the risk of the other occurring?
Well, as you know, we cannot forecast short-term the New Zealand dollar, and nor can anybody else. So we have to work on risks. We have, over recent years, tended to expect that New Zealand dollar to come off faster when it hasn't, or sometimes when it hasn't at all. And there is always that risk that's there. That we have to work on two-tail risks, though. It could also move. I think you can think about various international scenarios that could drive it in either direction. Unfortunately, that's a world that we, as on monetary policy, and that a lot of businesses have got to operate within, looking at prospects of it moving in both directions.
Dr. Bollard, it seems in this sort of last period of volatility, central banks have looked to switch some of their reserves into gold. And I wondered if that's something that the Reserve Bank of New Zealand has done or is looking at doing. And the other question I had was, is there anything you can tell us about the process to name your replacement?
The answers to those two questions are no and no. The replacement process will be worked through, of course, as you'd expect, in a proper way by the non-executive part of the board of the bank, and that's what you would expect. Gold, the Reserve Bank got rid of its gold back in a long time ago, and no, it would seem a rather strange thing to do given the price of gold to suddenly rush for that.
Dr. Bollard, have you decided what you're going to do after the Reserve Bank?
There's a Swedish proverb that says, "The afternoon knows what the morning never suspected," James. Are there any other questions? Good. Well, thank you very much for coming, everybody. That's the end of the session.
I know. I thought we had quite a few.